You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Ken Keating, a 25-year options veteran with roles ranging from market maker to risk and portfolio manager, amongst others, as well as a fellow options instructor here at OIC. Ken, welcome back.
Well, thank you for having me again, Mark. It's a pleasure to be here today.
Ken, I was at a conference recently, and I had an interesting discussion with a couple investors about the pros and cons of debit and credit spreads. And seeing as how you'll be covering those concepts and a whole lot more in your two upcoming OIC webinars, I was hoping you can give us some insight into these strategies. How does that sound?
Sounds great.
All right, terrific. So for any beginners that might be listening, let's start with the basics. What are spreads and why do traders turn to them?
Well, simply put, spreads are the purchase or sale of one option and then the purchase and sale of another option against it. So, obviously for option buyers, people who buy options outright, they pay a upfront amount of money, a debit, and whether you're buying a call or a put, you have, in the case of a call, you have unlimited upside. In the case of a put, you have unlimited downside. A spread essentially lowers your overall cost of that position, but at the same time will cap your profit potential either on the upside or downside. So in a sense, you're hedging yourself, lowering your cost of that position, but also limiting the amount of potential profit on that position.
Okay, so the trade-off is to reduce your risk, and the risk we're talking about the premium that you pay for the option. To reduce that, you can trade another option against it, but the trade-off is that you may have reduced risk, but now you've also got reduced reward potential.
That's correct.
Okay.
Absolutely.
All right. So so those are spreads. Let's go ahead and get into debit spreads to begin. Am I correct in that the idea is that while buying a call or put to speculate, while it potentially affords the investor with either unlimited gains to the upside for calls or significant gains to the downside for puts, the likelihood of a stock going up to infinity, let's say, or down to zero, it might not be all that realistic. So with that in mind, the question becomes, why pay for all that potential stock price movement when the reality might be something considerably different, right?
That is correct, right. So, as you mentioned, in theory, call has unlimited upside because there's no cap on to how high a security could move. And on the downside, obviously, a security can only go to zero. But, the likelihood of that happening, while can happen, is probably pretty low.
Mm-hmm.
Something more realistic is if maybe a stock is going to move 10% up or down, or maybe 20%. That might be a little more realistic. So knowing that, or having that price range in mind, now you can use options and put on spreads that will allow you to participate up until that percentage move that you anticipate, while not having to outlay as much in capital to put on that position. So once again, by selling an option against an option you're long, you are in a sense hedging yourself, but at the same time you are limiting your potential profit position.
So if we had, for example, a stock trading $50 and we think that maybe there's a potential for a 10% increase, if we bought the at-the-money $50 call, that gives us the benefit of, as you mentioned, the stock going to infinity.
Right.
The likelihood of that happening is probably pretty small. So if we're expecting a 10% increase, maybe we sell a $55 call against it, reduces the overall risk, but also reduces our profit from $50 to $55. It gives us that spread, hence the term.
Correct.
By reducing that premium. Okay. And I'm assuming for puts that works in reverse, yeah?
Absolutely. With a put, obviously, a stock can only go to zero.
Okay.
I have seen stocks go to zero, and I've been on the wrong side of stocks that go to zero.
Sure.
It's no fun, but that on the downside, your losses are capped to a degree.
Mm-hmm.
But realistically, the idea, of a solid company going to zero is pretty remote. So in this case, you might consider a spread rather than the outright purchase of a put or a call.
Okay, that makes sense. Thanks for that. All right, so now let's switch gears and talk about credit spreads. So aside from the idea that you're now collecting premium rather than paying for it, hence debit versus credit, how else do credit spreads differ from debit spreads?
Well, as said, debit spread requires an initial debit, meaning that the option you're paying for is always going to be more expensive than the option you're selling, which always results in a net debit, which is going to cost you to put on that position. A credit spread, on the other hand, is just the opposite. You're going to sell the more expensive option, buy the cheaper option to hedge yourself, but that's going to result in a net credit, which goes into your pocket. So, the risk dynamics, with a credit spread is just the opposite of a debit spread. So in a credit spread, the most you can make is the initial credit that you receive when you put on that position. The most you can lose is the difference between your two strikes, if we're talking about a vertical spread. Mm-hmm. In other words, a spread in the same month using different strikes. Your potential loss is the difference in strike less the credit that you receive. So if I sell if it's a $5 wide spread, let's say I sell the 50-55 call spread, and I sell it for $3. That $3 goes into my pocket. That's mine to keep. But potentially I could lose the difference, $5, minus that credit, $2. So my risk is the $2.
Okay. And then back to debit spreads, which we talked about a minute ago, it's the reverse, right? The premium that you pay, the net debit that you pay, that's going to be your maximum loss.
Correct.
And then your maximum gain is the difference between those two strikes minus the premium that you pay.
It's just the opposite.
Right. Perfect. Right. So that makes sense that it works that way.
Yeah.
credit spreads. When I think of credit spreads, I think of selling. When I think of selling, I think of assignment risk.
Correct.
How does that work with spreads, whether it's a debit or a credit, because you're selling options on both?
Right. So anytime you're short an option, whether it's with a debit spread or a credit spread, when we're talking about American-style options, you are still at risk of being assigned on the short leg.
Mm-hmm.
So we always tell people that while spreads are a risk-defined strategy, that defined risk really only exists within the spread itself. So an exercise by the long holder or an assignment by somebody who exercises the short leg on you and you get assigned, that can throw the risk dynamics of that position out the window. So it really only, the defined risk nature of a spread only exists within the spread itself. That's a very important concept.
Okay, let's go ahead and stick with that assignment risk that we were talking about, because I know that assignment obviously is a major risk for spread traders, regardless if they're buying or selling. So let me give you a scenario, and you tell me what risks it might pose to a spread trader. Let's assume that an investor sells a bear call spread, right? So they're selling a credit spread. They're short the 100 calls, and they're long the 105s for protection, let's say. Expiration comes around, stock closes at $99, and both legs finish out of the money, and the investor is expecting to keep 100% of that premium paid. Now, let's add a wrinkle that news comes out after the bell and shares rally to 110 or even higher. Just because that spread finished out of the money at the close, it doesn't necessarily mean that the investor's out of the woods, does it?
That's correct. So, and this is a misconception that a lot of investors have, that just because my options closed out of the money on the close, the New York close, means my options are going to expire worthless. So just know that whether you're when you're short options, you can still be assigned on those options even on expiration after the close. So typically there's a window for member firms. OCC requires that they get their assignment, exercise and assignments into OCC the exchanges by 90 minutes after the New York close. Okay. Now, brokers themselves have their cutoff time might be slightly different, so you'll want to check with your broker as to what their policy is regarding exercise after the close.
And for their clients, for a trading firm's investors, that cutoff time is typically significantly sooner than that 90 minutes.
Right. I mean, I've heard of firms having a cutoff period as low as 10 or 15 minutes after the close, while some firms extend their customers the full 90 minutes. So you'll want to check with your broker as to what their exercise cutoff threshold really is, because it does vary from broker to broker.
Okay.
But getting back to your scenario, so, stock closes at 99, I'm short the 100, 105 call spread. It appears that it's going to expire worthless. Let's say I sold it for $2. And I'm thinking, well, that $2 is mine. Both options expire worthless. But then news comes out after the close, and now stock's trading 110 or higher. If the stock's trading 110, my short 100 calls are technically $10 in the money. My long 105 calls are technically $5 in the money. So if I do nothing and I don't exercise my 105 calls, I could very well wake up on Monday morning short 100 shares being assigned at the 100 strike, and subject to all the risks that being short stock would entail on Monday morning.
In this case, you're down $10 per share on stock that you didn't even expect to, be short.
Right. I was assuming that I was going to make a $2 profit, since I sold the spread for $2, and then I wake up on Monday morning and all of a sudden I'm short stock and I wonder what happened, and I'm sitting on $1,000 net loss.
Right. And this goes for any trade in which you're selling options, not just spreads, which is likely why so many traders try and close even their out of the money short positions prior to expiration to eliminate any potential assignment risk.
Correct. So the only way to truly mitigate against an unwanted assignment is to either, one, buy back that short option on or before expiration, or just trade out of the spread on or before expiration. Mm-hmm. Because once you buy back that option, you are no longer subject to assignment risk. And then if the stock moves in the aftermarket, you can make an independent decision whether you want to exercise your long contracts based on where the stock is trading on news or whatnot. But you also keep in mind that, stock closed at 99, you're long the 100 calls, you're short the 10. I'm sorry, the other way around. You're short the 100 calls, you're long the 105s. You would still have to manually exercise that 105 call to, if you do nothing, technically it's not going to get automatically exercised because it finished out of the money. Right. You'd have to manually exercise that contract through your broker by your broker's cutoff time.
Okay, excellent.
Yeah.
We've got a few minutes left, so let's talk Greeks. When buying or selling a spread, we net the cost and subtract our sales from the buys to arrive at a net price. So if we pay $4 for a $50 call, and then we sell the $55 call at $1, let's say, our net price is that $3 overall debit. Do the Greeks work a similar way? Meaning, do we aggregate the value of, the long delta versus the short delta, et cetera, or do the traders look at the individual values? Right.
So, every option has its own price, and every option has its own set of Greeks. So if I'm short going back to your example, if I'm short the 100 calls, and let's just say it's not expiration, and I put the position on stocks trading 100, I short the 105 call on 100 calls, I buy the 105s. Well, since the 100 calls are technically at the money, they're going to have roughly about a 50 delta. And since the 105s are technically out of the money, maybe they have a 25 delta. So I'm short 50 deltas on the 100 call, and I'm long 25 deltas on the 105 call. That's a net short 25 deltas. So you net out your deltas, just like you're netting out your either credit or debit based on the prices that you're putting on. Your deltas all your Greeks get netted out as well. So that goes for delta, gamma, vega, theta. It all gets netted out. Right.
So if your net delta is, say, short 25, as you had mentioned, we would expect the value of that spread, not the individual legs, but the value of that spread to move by 25 cents for every dollar that the stock moves.
In theory, if the stock, goes up to 101, in theory, my spread should increase in value by 25 cents. Mm-hmm. All the other factors remaining constant. So, if I sold that spread for $2, in theory, if the stock goes up by $1, it should probably be about $2.25. Not counting implied volatility changes in time and whatnot, but just looking at it from a delta perspective, I should expect my spread to be worth 25 cents more, which if I sold the spread would mean I'd be sitting on a 25-cent loss.
Okay, excellent. Great information. Ken, thank you so much. We're very much looking forward to what you and I discussed today, but I'm sure several other aspects that we haven't covered. Listeners, you can register for Ken's upcoming webinars via the events section of our OIC website, optionseducation.org. Ken, thank you so much for joining me today.
It's always a pleasure, Mark. Thank you for having me.
And thank you to all of our listeners and supporters out there. As always, please feel free to send your questions via email at options@theocc.com or live chat with us on our website. Thanks again to all those listening, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.